And a good day to all our real estate friends out there. Boy, there's a crazy market out there with this high rate environment. Starting to see sales slow. Not that our comps don't show that the values are there. Home buyers are a little bit concerned about the higher rates and affordability. How do we get around that? You may have been hearing the terms 2-1 buy down, 2-1 buy down. Got to do a 2-1 buy down. So what is that? Hey, let me spend a few minutes here and walk you through the dynamics of how a 2-1 buy down works. I'm going to throw you an example there and get your brain cells fired, because these are conversations that you need to have with your sellers and your buyers here. So let me go ahead and share a screen, and I am going to start rolling it out. So what is the art of a 2-1 buy down? Let's explain this. Okay, a 2-1 buy down is a type of financing that lowers the borrower's interest rate on a mortgage the first 2 years before it rises to the current locked rate. And we're just going to use 7% because there's some easy numbers to get through our head here, but it works in any rate environment or on any rate. So now the start rate is going to be 2% lower than the locked rate for the first 12 months. Then the rate will increase after 12 months by 1% for the second 12 months. And in the third year, it will revert to the fully indexed rate of the 7% we're talking about here. So sellers, including home builders, may offer a 2-1 buy down to make a property more attractive to buyers. To make up for the interest that the lender will not receive in those early years, sellers and builders can prepay this fee upfront at closing. And we all know what seller concessions is, so it's going to be treated like a seller concession. It's just going to be called a temporary buy down. And we'll go over the addendum verbiage that you're going to need in your contracts. So the temporary buy down fee may be in the form of either mortgage discount points and or a lump sum. These funds will be deposited in an escrow account with the lender servicer at closing and will be used to subsidize the buyer's reduced monthly payments. These charges will show as a charge to the seller/builder side of the CD. Sellers and also home builders can offer a 2-1 buy down as an incentive for potential purchasers. This strategy yields a more powerful tool for a borrower than a price reduction, and we'll go over that analogy as well. So let's just take, for example, standard $400,000 purchase, 5% down, current market rate, 7%, 30-year fixed rate loan. That would be a loan amount of $380,000. And that buy down would cost $88.57 right here. And that's about 2.215 of the purchase price. And very normally we'll ask for 2 or 3% for seller concessions. Now, if the seller's asking 400 grand and we wanted a price reduction, and let's say in this example, well, we're not giving 400,000, we're going to get 88.57 less than 400,000. That price reduction, the new price would be 391 and some change, 5% down, 7%. The principal and interest payment alone would be 2472. As we move on with that traditional thinking, and the buyer offered 88.57 less because he wanted a price reduction, that 88.57 would equate to about 59.92 payment reduction. Not so bad. We've all seen that in the past. So, okay, let's move on here. But if we do this with the buy down strategy, we do not lower the sales price. Just think if everybody lowered their sales price out there by 9 grand, well, that's going to bring values down, and our comps are supporting these higher values here. So we'll keep the $400,000 sales price and negotiate a buy down instead of a price reduction. The seller accepts a 2-1 buy down offer of 400 grand, and that's the same as that price reduced 391 sale. But here's the good stuff. Now we can make it a much more attractive and affordable for the buyer and get them off the fence. And we can make the home much more marketable in a volatile, higher interest rate environment for the seller. So remember that 391 reduced price, and we have the 2472 a month payment. Now let's see how the 2-1 buy down works. Here we go. If we do the buy down, 400 grand, 5% down, 380 loan, 7% rate. That principal and interest would be $25.28 because we're not reducing the price. So it goes up that $59. Okay. However, in year one, our client, our borrower, is not at a 7% rate. He's at a 5% rate, and his principal and interest is $2,039, saving $488 a month, or 19% payment reduction in the first 12 months. The second 12 months, the rate will increase to 6% for a $249 savings per month. His payment would be $22.78, or saving a 9.8% payment reduction. In year three, it reverts to the fully indexed 7%. His payment would be that $25.28 for the remaining 28 years. So now here's the cool thing. If that home is refinanced or sold in the first 24 months, that remaining escrow funds is credited back to our borrower. So I want you to think of, we all know what down payment assistance is. Think of this as payment assistance. So when we charge the seller, or we do a 2-1 buy down, and that seller's paying $8,857, that money is put into an escrow account with the loan servicer. So our borrower in year one will pay $2,039, and the servicer will pull $488 a month out of the escrow account to subsidize the payment, so the investor, the end investor, gets the full $25.28. Year two, borrower pays $22.78. The escrow company then puts in $249 to equate to that fully indexed rate, which the investor is expecting. Do all investors offer 2-1 buy downs? No, not all of them. So you got to check with your lender and see, make sure they have investors that will accept 2-1 buy down financing here. Okay, so remember that reduced offer, $391 and some change. That payment was $24.72, and you're saving $59 a month. Okay, that's the price reduced offer. On the 2-1 buy down, we're saving $488 a month, and second year saving $249 a month. Okay, so now that we remember that, remember, we're saving $488 in the first year. And if that buyer is comfortable with that reduced payment, just think, if he wanted to buy right now and did not use this strategy, that $488 equals a mortgage amount of $73,000. So if he's not out there looking for a $400K purchase without the 2-1 buy down, you would have to ask the seller for a $73,000 price reduction, or that guy's looking at it, or that buyer's looking at a $325,000 property. So I want you to understand how powerful this tool can be. Next slide here. So now, how is the buy down calculated? Okay, it's very simple, because there's no interest that's not being given. That investor is going to get the full interest. So we take the savings of $488 a month times 12 months is $58.58 in the first year. And in the second year, we take the savings times 12 months, it's $29.28, and that equates to $88.5708, exactly what the loan origination system has calculated here. So it's pretty simple, and your lender ought to be able to figure this out in about 60 seconds. Okay, so now, as we go on, now, not that this matters, but remember that $88.57 price reduction? Well, if you would have done that and you were 3% on the buy side or the list side, that's a reduction of $265 in lost commission. So to me, is it worth having that conversation for $265 to your sellers, to your buyers, to get everybody together to try to get this transaction moving and get the buyer more comfortable with a 2-1 buy down so they can ease into the payments? So now let's talk about that here, easing into the payments. So in Livingston County, the average median income, I think, is about $86,000 there. And at a normal 3% raise every year, that first year they'd make about $224 more a month on a raise. The second year, about another $230. And in that third year, they would make another $200. So that's over $600 that borrower should be making in a 3-year time frame, which more than equates that $488 drop in payment. It should be affordable at that point. Okay, so now, as we go on, so having these conversations with the sellers, why is my home not selling here? Why am I not getting multiple offers anymore? Rates are going up. Are the buyers scared? Yes, they are a little bit there. And how much do I have to reduce my price to attract buyers? Maybe not anything here. And why do the comps support my sales price, but there's no offers? It's just a very kind of critical market uncertainty, and the market does not like uncertainty at all. So now, conversations we could have with our buyers, because our rates are high and payments are becoming unaffordable. This solution helps them to move forward with their objective of getting a roof over their head. This strategy allows buyers to ease into the payments, which is very comfortable. Oh, and if I did not say this already, if that buyer was to go into the 2-1 buy down and they were to refinance or sell that house in the first 2 years, any remaining balance in that escrow account is credited towards that buyer. So it's a no-lose situation, because ultimately we are hoping that the feds get inflation under control, supply and demand come back in check, inflation drops, and along when inflation drops, interest rates will drop. Okay. So now on the purchase agreement, what you're going to want to read is the seller to contribute X percent or X dollars towards buyer or buyer's closing costs, prepaid items, and or temporary buy down. It has to say temporary buy down. Okay. So I'm hoping that this helped you out to understand it. Your lender that you're working with should understand this as well. But if you need any help with any marketing pieces, from brochures, objection handling, and how to have these conversations, I believe it's just a phenomenal tool here that we can use in this high rate environment here. So also, kind of cool, there's also 2 other products. There's the 1-0 buy down, where the buyer can buy it down just 1% in the first year. And then there's the 3-2-1 buy down. So if today's rates were at 7% and we negotiated a 3-2-1 buy down, and those are a little more expensive, I think they're right around 4% of the purchase price. If we were to close today and they had a rate of 7, it would start in year 1 at 4%. The next year go to 5%, next year 6%, and then ultimately it would go to 7%. So these are very powerful tools. Get some knowledge on them. Get those conversations. Understand how the products work. And if you have any questions, give your loan officer a call or give us a call over here. You can give me a call, 734-417-2115, or you can get me email, vic@victorbales.com. And we hope to see you soon here and have some great conversations.